You're watching everyone around you make the same mistake. They see the warning signs, volatility creeping in, headlines getting darker, and their first instinct is to protect what they have. Pull back. Go defensive. Wait it out. And I get it. When the ground starts shaking, you want solid footing. But here's the uncomfortable truth. The people who get rich aren't the ones hiding when everything breaks. They're the ones who already decided what to do before the chaos started. I'm going to walk you through something most investors never figure out. Not because it's complicated, it's not, but because it requires you to act when every nerve in your body is screaming at you to freeze. Let's start with what actually happens during a downturn. Prices collapse, not because businesses suddenly become worthless, but because fear spreads faster than logic. And when that fear peaks, when your neighbor's losing sleep and financial experts are saying it's different this time, that's when the sale begins. Everything you wanted to own 6 months ago is now 40% cheaper. But instead of loading up, most people are selling. That's the paradox. That's the opportunity. Here's what separates the prepared from everyone else: cash position. Right now, before anything breaks, you need liquidity. Not because cash is exciting, it's not. It loses to inflation in normal times. But when asset prices crater, cash becomes the most powerful tool you have. It's your ammunition. And if you're fully invested when the downturn hits, you're just a spectator watching values evaporate with no way to capitalize. Think about keeping 6 months of expenses liquid at minimum. More if your income stream isn't bulletproof. Then beyond that, set aside capital you won't touch. Money earmarked specifically for buying when everyone else is capitulating. This isn't emergency money. This is strategic money. Now here's where most people fail, even if they have cash ready. They don't know what to buy when the moment arrives. Because in the middle of a crisis, emotions override analysis. Everything looks risky. Everything feels dangerous. So they hesitate, second guess, and miss the window entirely. That's why your real work happens now. You build a watch list. Companies you'd love to own if only they were cheaper. Not speculative plays or distressed junk, but quality businesses with durable advantages, strong balance sheets, recurring revenue, brands that won't disappear when times get hard. You study them now, understand their economics, know what they're actually worth. Then when prices drop, you're not scrambling to research, you're just executing a plan you already made. Let me show you what this looks like in practice. In 2008, while banks were imploding and retirement accounts were getting gutted, certain investors were writing billion-dollar checks. They weren't guessing. They'd already identified which institutions would survive, which had the capital reserves to weather the storm. And while the crowd was paralyzed by fear, they were signing deals. Those positions multiplied several times over, not luck. Preparation meeting opportunity. But here's the trap that destroys more portfolios than anything else. Leverage. Borrowed money feels like a shortcut when markets are climbing. You can amplify gains, move faster, control more. But when things reverse, leverage doesn't just hurt you, it eliminates you. You get margin calls at the worst possible moment, forced to sell at the bottom, and everything you built evaporates. I don't care how confident you are in your thesis. I don't care how cheap something looks. If you're using borrowed money, you're one bad sequence away from being permanently sidelined. The goal isn't to maximize short-term returns. It's to stay in the game long enough for compounding to work, and leverage is the fastest way to break that compounding cycle forever. Now let's talk about diversification, but probably not the way you've heard it before. Owning 200 stocks isn't diversification, it's just confusion. You can't possibly understand that many businesses deeply enough to know what they're worth when prices swing violently. Real diversification means holding 10 to 15 companies you genuinely understand across different sectors with different risk profiles. Some businesses hold up during downturns. Utilities keep generating cash because people still need electricity. Consumer staples keep selling because people still buy toothpaste and groceries. These aren't glamorous, but they're stable. And that stability gives you the confidence to stay aggressive elsewhere, to buy beaten-down cyclicals when they're truly cheap, because you know your foundation isn't crumbling. Here's something else you need to internalize. Balance sheets matter more during downturns than any other time. A company might look cheap on earnings multiples, but if it's drowning in debt, it won't survive long enough for those earnings to matter. When revenue drops and credit tightens, over-leveraged companies collapse. Shareholders get wiped out. So when you're building that watch list, dig into the financials. How much debt are they carrying? Can they service it if revenue falls 30%? Do they have cash reserves? Because weak companies don't just struggle during downturns, they disappear. Strong companies with clean balance sheets take market share and emerge more dominant than before. And here's the mindset shift that changes everything. Time horizon. If you're thinking in months or even quarters, downturns are terrifying. But if you're thinking in decades, they're just noise. Temporary disruptions in a long-term upward trajectory. The economy has grown for over 2 centuries. There have been dozens of recessions along the way. They always feel permanent when you're inside them. They never are. Imagine buying a productive farm at a fair price. The next year, there's a drought. Crop yields collapse. Neighboring farms sell at steep discounts. Do you panic and liquidate? Of course not. You know the drought is temporary. You know the land will produce again. That's how you think about owning pieces of businesses. Short-term chaos doesn't change long-term value if you chose well. But none of this works if you're living paycheck to paycheck. If every dollar you earn gets spent, you can't save. You can't invest. You can't build the reserves that create opportunity. And when the downturn comes, you're not positioned to take advantage. You're just trying to survive. This is why lifestyle discipline matters more than almost anything else. It's not about deprivation. It's about insulation. Every dollar you don't spend on things that don't matter is a dollar that can work for you when it matters most. Live below your income aggressively. Build that gap between what you make and what you spend. That gap is your freedom. And watch out for lifestyle inflation. You get a raise, and suddenly your expenses rise to match. Bigger apartment, nicer car, more expensive habits. You're not actually saving more. You're just spending more. The smart move is to keep your lifestyle flat and bank the difference. That's how wealth actually builds. That's how you create the buffer that lets you act when others can't. Now, during a downturn, you're going to be bombarded with information. Every headline screaming crisis. Every analyst predicting worse to come. And if you're consuming that all day, it's going to infect your thinking. Fear is contagious. Panic spreads through narrative. Stay informed, but don't marinate in it. Check the news once, maybe twice a day. Get the facts you need. Then focus on what actually matters, the fundamentals of the businesses you own or want to own. What are their earnings doing? What's their competitive position? That's your compass, not what some pundit is saying on television. Here's another critical distinction: price versus value. During a downturn, prices fall dramatically, but the intrinsic value of quality businesses doesn't fall nearly as much. That gap between what something costs and what it's worth is your edge. A company generating $10 million annually might trade at $150 million in good times. In a crisis, that same company might trade at $60 million, even though its fundamentals haven't changed much. That's the opportunity. You're buying the same economic engine at a steep discount, but you can't identify that gap if you're fixated on price action. You have to look through the chaos to the underlying value. What will this business earn over the next 10, 20 years? If you can answer that, the current price becomes less relevant. You're focused on what you're getting, not what you're paying. And don't try to time it perfectly. You won't catch the exact bottom. Nobody does consistently. If you wait for absolute certainty that the worst is over, you'll miss the recovery. Prices rebound while most people are still paralyzed. The better approach? Start buying when conditions are clearly deteriorating and prices are clearly depressed. Then, if they fall further, buy more. Average in. You're not trying to be perfect. You're taking advantage of obvious mispricing. And when the recovery comes, that averaged position will do extremely well. Study history. Every downturn has different triggers: credit crisis, demand shock, asset bubble bursting, but certain patterns repeat. Leverage kills. Panic creates bargains. Quality survives. Patience gets rewarded. Read about past recessions. Understand what worked and what didn't, because the specifics change, but the principles don't. Here's where most people with all the knowledge and all the preparation still fail: execution. When the moment arrives, when prices are collapsing and fear is peaking, they freeze. They can't bring themselves to buy because it feels dangerous. It feels like catching a falling knife. Every instinct says, wait. That's why mental rehearsal matters. Visualize the scenario now. See prices dropping. Feel the uncertainty. Then see yourself staying calm and executing your plan. Run that simulation repeatedly, because when it actually happens, it won't feel new. You'll have already been there mentally. That preparation is what gives you the courage to act when others are paralyzed. And then comes the hardest part: patience. You buy during the chaos and things don't immediately improve. Prices bounce around. They might drop further before recovering. That tests your conviction. But if you chose well, if you bought quality at reasonable prices, you just have to wait. The recovery comes. The businesses perform. Prices eventually reflect that. But it takes time, sometimes years. You're planting seeds during winter. You don't keep digging them up to check if they're growing. You protect them and wait for spring. That's what investing through a downturn looks like. Plant your positions. Trust your work. Let time compound. Look, the next downturn is coming. Maybe next year, maybe 5 years from now. But it's coming, and you can either be someone who watches their portfolio shrink while paralyzed by fear, or you can be someone who's been waiting for exactly this moment. The difference isn't intelligence. It's not luck. It's preparation and willingness to act when acting feels impossible. Build your cash position now. Identify quality businesses now. Study balance sheets now. Get your mind right now, because when chaos hits, there won't be time to figure this out. There will only be time to execute or freeze. The people who build lasting wealth aren't the ones who avoid downturns. They're the ones who prepare for them, recognize them for what they are, and have the discipline to move when everyone else has stopped breathing. Thanks for watching. Subscribe and turn on notifications so you don't miss what's next.